in case you need it for your careers. And so with that, let's go ahead and share screen and get started. So cash flow forecasting. And so I personally think this is critically important that companies do a cash flow forecast. Unfortunately, many don't, but I think it's important to know your sources and uses of cash, whether it's in your own personal financial situation, or if you own your own business, or if you're running a publicly traded company. Cash flow forecasting is critically important because it's going to identify, do you need to obtain external financing or your internal operations generating enough cash for your needs? And so with that, let's go ahead and jump in. As we talked about before, the sequence is critically important. You've already seen it in the balance sheet. You're going to see it again in the statement of cash flows. You need to first do your income statement forecast with a special emphasis on net sales. A lot of the items within that income statement forecast feed your balance sheet forecast. And then both the income statement and balance sheet are really going to feed a lot of the line items within the statement of cash flows. So statement of cash flows, as we talked before, three sections: cash from operations, cash from investing, cash from financing. So we'll start with cash from operations. As we talked about before in an earlier module, cash from operations, simply what it's doing, it's taking net income, it's on the accrual basis of accounting, taking that net income from the income statement, and then reconciling that net income to the cash basis of accounting by taking changes in non-cash items, changes in your operating assets and liabilities. And in order for our cash on the statement of cash flow to tie back to the balance sheet, likely we're going to have a plug, and we're going to plug the other line item within cash from operations to ensure that our cash from the statement of cash flow ties back to the balance sheet. And so let's go ahead and get started. So again, net income. Net income on the accrual basis of accounting, we're simply going to pull this from our income statement forecast. Then depreciation. And so depreciation, a lot of times driven by changes in plant, property, and equipment. Plant, property, and equipment. Remember, we had that growing or supporting our sales growth. So that was growing 5%. And so we're going to have depreciation growing by 5%. Amortization. So amortization a lot of times relates to acquisition activity. For our forecast horizon, we're not going to assume any new acquisitions. And so we're just going to assume that amortization expense is going to remain equal to, or the add back of amortization expenses. We reconcile net income from the accrual down to the cash basis of accounting. We're just going to assume that that's going to be consistent with the most recent fiscal year. These other line items, so changes in fair value of business acquisition, are there going to be any impairments or any gains? These are non-base business, non-core items, and you can see that, for example, change in fair value of business acquisitions that went from 0 to 1 to minus 93. So really no observable trend. We're not going to assume any new acquisitions or M&A activity over the forecast horizon. So we're just going to assume no cash impact for these items. Same thing with asset impairment as well as gains. Just too much volatility. It's not related to our core operating results of the business. And so we're going to assume that they're going to have zero cash impact. Deferred income taxes. Remember, on the balance sheet, we assume that income tax items would vary based upon net income growth rates. Well, that's the same thing we're going to do here. We're going to take those net income growth rates from the income statement and apply that to, as we reconcile net income from the accrual basis down to the cash basis of accounting. Non-cash compensation expense. So this is executive compensation. And it's been around 20 million every year. And so we're going to assume that the company's still going to continue to provide executive compensation. And so that add back, that non-cash effect of granting stock awards to our executives is going to remain flat with the most recent fiscal year or continue to be around that $20 million mark. And finally, other, we're going to come back to this later, but ultimately we need to make sure that our cash on the statement of cash flow ties back to cash on the balance sheet. So this other is going to be our plug. Right? And so we'll come back and we'll plug this so that our statement ties to the balance sheet. Accounts receivable, inventory. So all of this is going to be based upon changes in our balance sheet line items. So we talked in an earlier module that as we reconcile net income from the accrual basis down to the cash basis of accounting, an increase in accounts receivable, debit AR, credit sales, well, this has the effect of increasing net income on the accrual basis of accounting. But we haven't received our cash yet. And so an increase in accounts receivable would be a reduction in the cash from operations as a reconciling item. And so what we do is we prepare our statement of cash flows. We look at our operating assets and liabilities and just calculate that year-over-year change from the balance sheet, that year-over-year change in the balance sheet, and that's what allows us to calculate these line items. Okay, and so now that's allowed us to complete our cash from operations forecast. Now, again, we're gonna have to come back and plug that other line item later, but essentially those are the moving parts, right? You start with net income from the income statement. You look at trends on depreciation, varying that based upon PP&E and thus sales activity. That PP&E is going to be an enabler or support of our sales growth. And then a lot of the other items, we're just assuming either a consistent cash flow impact, or if it's non-core operating, we're just going to assume zero cash effect. And then once we get down to our changes in operating assets and liabilities, well, we're just simply calculating that year-over-year change from the balance sheet. And again, that's just another point that you have to complete your income statement, then your balance sheet forecast before you do your statement of cash flows. And so we're about 95% of completing our cash from operations forecast. We'll have to come back and deal with that plug so that our cash from statement of cash flows equals our cash on the balance sheet. Cash from investing. Again, think about what this section tells an investor. This is how the company or management is investing its cash. None of this has an income statement impact, but it's usually cash inflows and cash outflows. A big driver of this is going to be capital spending, usually related to PP&E. Remember how we handle PP&E? Well, we align that with our sales growth rates. We'll handle that this cash flow forecast similarly. Then also within the investing activity, if there's any acquisitions or mergers and acquisition activity, that would be here. But in order to keep the focus on our core base business, we're going to assume that there are no new acquisition activity over our forecast horizon. And then another will either keep it flat the prior year or consistent with trend. And so CapEx, driven by PP&E driven by our sales or in support of our sales growth. That was growing 5%. That's how we're going to grow our CapEx. We're not going to assume any new acquisitions, and so zero cash impact there. And then the other line item, an observable trend around 1 to 4.8 million. So we'll just plug in the most recent fiscal year or have that equal to $3.5 million, right? And so now we've completed our cash from investing. And finally, cash from financing. So how's the company financing its operations? Well, the key assumptions is that what are we going to do with debt? The assumption we made for debt and interest expense on the income statement and balance sheet is that there would be no new debt issuances or pay downs. So we're going to keep that activity flat with the prior year. Stock issuances and repurchases and executive compensation. Well, we're going to have to draw on some of our earlier assumptions from the income statement and balance sheet. And then ultimately, before we're complete, we need to ensure that our cash balance ties back to the balance sheet, right? And so borrowings, repayments, we're just going to assume that debt will be flat, right? And so no cash impact. Proceeds from stock options, right? So it's ranged from about 50 to 93 million. This is executives going in and exercising their stock options where they buy stock from a company based upon a predetermined price. We're just going to keep that flat with the most recent fiscal year, right? Company's going to continue awarding stock options. Executives are going to continue exercising those stock options. So there's going to be a cash inflow effect here. Dividends, we saw that dividends on the balance sheet, on the equity section of the balance sheet would grow 5%, or that was our assumption, right? And that's been a historical trend. We're going to assume that to continue. And repurchases of treasury stock, a pretty observable trend here. So increasing 50 million every year. We're going to continue that 50 million increase over the 3-year forecast horizon. And so repurchases of stock or treasury stock, we're going to base that upon trend activity for our cash flow forecast. And then acquisitions and other acquisitions, again, we're not going to assume any M&A activity. And then this other, it's a pretty small amount. And so we're just going to assume zero cash flow impact. Same thing with foreign exchange rates. I mean, so unpredictable. And so to keep the focus on the core operating results of the business, we're just going to assume that currency essentially is going to stay flat versus the prior year, or said another way, no cash impact on currency. And ultimately, we need to make sure that our cash balance ties back to our balance sheet. And so that's where we're going to have to go back and plug the other line item within cash from operations to make our cash balance. Okay. So with that, hopefully you've have a better appreciation for detailed forecasting, the sequence, the forecast assumptions and the drivers, and the need for that internal consistency. But as always, if you have any questions, please feel free to reach out. Thanks, and we'll see you soon.